That being said, for any of you that are watching for the first time, my name is Christina Cabrina, and I'm the Chief Economist and Portfolio Manager at Sequoia Wealth Advisors. As you can see from my background, it is a real background. I am actually in the Nevada office this week, so a slightly different setting than the usual coastal office. But that being said, just a couple of housekeeping items, because I continue to hear that there are people that watch it for the first time, or people will send excuse me, I'm turning something off here, will watch for the first time, or they'll get a reporting later from a friend or someone who's watched it, and they don't quite know what this is and who I am. So I'm going to go through a little bit of the housekeeping just for that. Another thing is, I got a lot of questions this week, a lot of questions. So I've done my best to consolidate them. Obviously, with the changing political environment, I've consolidated and kind of changed a few things on Monday. But that being said, if I miss anyone's question, please post it. If you have questions, please post it right away. Don't wait to see if someone else asks a question. Just get them out there, because sometimes what happens is I get a lot towards the end, and out of respect for your time, I don't like to run long. So send them right away. I will just skip past them if they've already been answered. Many people send questions in advance, because during the pandemic, we had large numbers of people watching live, and the questions were coming through then. But now, back to work, back to life and whatnot, the middle of the day, the middle of the week doesn't work for everyone to watch live. So have the questions there. Also, any questions you send in. So again, please do send your question in well in advance, because I'll be sure to get them answered. So without further ado, I'm going to jump into the outlook for the economy. It's kind of the mid-year now, mid-year point, talk a little bit about what to expect for the rest of this year into early next year. This is a really pivotal point. It's one of the points in the year when there's the greatest clarity on what's likely to happen next, because companies now, as we're in earnings season, begin to guide for the rest of the year. They have a pretty good sense of it. Not so much this time, and I'll explain why in just a moment. Because I've been talking a while about a shift that will take place as the government spending kind of works its way through the system, and what those impacts may be. And that really has come up with a lot of the questions about the economy, kind of what's happening next with everything going on. That being said, before I jump into the economy, I'll get through the part that has had the most questions. They really are around what's happening in the political space right now around the election. Couple of caveats to that. Number one is things are changing rapidly. What I would have said 3-4 weeks ago is so different than what it is today. So that being said, please timestamp this for the date that I'm saying it, because it could be very different in the coming weeks. But I'll definitely address those. Originally, I was going to push them into next month's webinar, because next month we have Bob Stein, our Washington economist, and we have him come out and speak each time there's an election, because he can really talk about what's happening inside of Washington, and his information and his expertise is far more valuable than what you see in the news, kind of behind the scenes, as well as probabilities and whatnot. So next month, if you want to go deeper into the Washington aspect of all this, the political and the election, Bob Stein will be our speaker. Many of you may have heard him in the past, and that would be really great to go deeper into it, and maybe with even a little more clarity, if that's possible at this point, than what I have today. But again, because these questions, not only what were sent for this webinar, but also questions that have been asked this week, there's a lot of concern, a lot of confusion, a lot of questions. So before I jump into that, my two disclaimers on this is, I don't have a dog in this fight. I don't belong to either political party. And I'm certainly not here to convince people to vote one direction or the other. It's a highly personal choice that will be made with so many different factors than just the economics of it. And my intention is kind of give a high level and then talk a little bit about the economics of it, or the potential economics on it, with the knowing that as time progresses, we'll get a lot more clarity on what the policies will be. When politicians are campaigning, they often say things differently than what they may or may not do when they're in office. And even if they really want to do when they're in office, we also have to consider that Congress has to work with Congress, right, to get things passed, especially in a split Congress scenario, which is highly probable. So just because they say something doesn't mean that's what they'll focus on once they get elected. Think of it like the advertising in relation to the job. So I don't have to tell everybody about everything that's happened over the last 3 weeks. I think you got plenty of that from the media. So I'm just going to kind of dive right into, at this point, the highest probability is Kamala Harris will be the Democratic nominee. It's not certain yet. It just has a pretty high probability at this point. So we're gonna go with that. And Donald Trump, of course, and JD Vance is the Republican ticket. From an economic perspective, I'll talk a little bit more about the Democratic side because we have least certainty there. The reason being is that we have Biden's economic proposals and policy and what he's clearly stated, not only himself, but also on his website, that he wishes to focus on if he was to serve the second term. What we don't know at this point is Kamala Harris going to take on the Biden's proposals, plans, basically his agenda, and move that forward if she was to be reelected? Or is she going to come up with her own ideas of what she wants to focus on, like basically her platform? Too early to say what that's going to be. The challenge that the Democrats have is there's really not a lot of time to re-educate voters, right? And not a lot of time, and especially the voters that are undecided, the moderates that are kind of undecided at this point, which is what each side is trying to capture, rather than the partisans that are already locked in on each side. So it's a little bit more challenging for her to come out and say, I have no experience. In my time in office, I've been focused primarily on social issues, not presidential issues, running a country, economics and other things like that. And I'm not really well known. And based on polling, does not have a lot of popularity even with her in her own party. Now, this can change over time, of course, as now she's in this new role. But these are all challenges that she will be really needing to focus on in the coming weeks to kind of again, teach the voters who she is, what she's going to focus on, and what her administration will look like if she was to be elected. So that's a big lift to do in a very short period of time. So if I went with probabilities, I'd say she'd probably lean a lot more towards continuing on Biden's programs and policies rather than putting in her own at this point. However, coming weeks will say what that's going to be. Another one is, it could be one thing what is said to get elected, right? Capturing those moderates, capturing the undecided voters could be very different if she was to get into office, right? And she's got more free reign to be who she wants to be and focus on what she wants to focus on. All we have right now to look at economically with her is what she's stated that she wants to focus on or what she supports in the past. Both in the 2020 election when she was running for president, as well as things that she said since then. The only two economic ones that I'll bring up, again with the giant caveat that she has not stated that this is her going forward focus or desire, is Medicare for all, which would be funded by taxes on all stock trades and bond trades. So basically every time a trade is placed, that would be taxed. And that money would go towards funding Medicare for all. That was the one. The other one was a bit more talking about tax credits and giving a $500 tax credit to people of a certain income level, kind of phasing that out up to $50,000 or $100,000 or so. So her overall economic policies or preferences that she's spoken of in the past have been more towards the progressive side than the more moderate policies of other politicians. So that is something to keep an eye on. Again, cannot stress enough, not telling anybody what to support or not support, but we want to watch that closely, because if she is to continue in that vein and if she's to be elected, that would have a major impact economically, not only on individual personal planning, estate planning, et cetera, but also could well have an impact on the markets. So we'll be watching that and definitely be giving you updates on each monthly as we get closer to the election, talking about the economic side. So that's really where I feel comfortable at this point, because I feel like there's a lot of unknown. Watching closely to see when she posts her website, when it kind of gets into the details of what she sees she wants to focus on, as well as how she would run the country, and also how she performs in debates, how she performs in kind of when she starts getting questioned on some of the more complex issues that she'll face as president and economic policy. We'll get a better sense. And again, I'll bring that forth to you. On the other side, clearly it's Trump and JD Vance. On the Republican side, it's a little clearer in a lot of ways what the economic policy would be based on policies stated and also based on things that have been focused on in the past. Biggest ones I'll bring up there are tariffs. Trump has made it very clear that he wants to place tariffs, especially on China. And that's something that we're going to need to watch very, very closely. Twofold. Number one, tariffs can be beneficial, but they can also have an economic impact on the cost of goods coming into the United States. So does he do this? Does he do this in a big way? Does he do it in a smaller way? Does he target China only? Does it become broader? That's something that we want to watch for. But the biggest one really that's going to be impacted by either administration coming in is going to be the expiration of the Tax Cuts and Jobs Act. So the Tax Cuts and Jobs Act was a tax policy that was put in place under the Trump administration. I won't get into all the details of what it entailed, but that being said, it is going to expire at the end of 2025 if it's not extended. Oftentimes, a lot of the talking points have gone there is it only benefited the wealthy and whatnot, but that actually is not factually correct. Things like doubling the standard deduction and a lot of other policies in there did have an impact across the different tax-paying categories. So for that to expire and go away will have a big impact on many, not all people. So I want to stress this. It's a very individualized thing, depends on your tax situation, whatnot. So the expiration of that will have an impact. Will have an impact on corporate earnings. It's a corporate tax cut will readjust higher. And that will also obviously have an impact on potentially markets and stock prices. So if we have a full-on Republican sweep, which is not highly probable, but certainly possible, it will almost certainly be extended. And if not enhanced, there'll be more tax benefits across the board. We keep hearing about eliminating taxes on tips. That's not specifically part of the Tax Cuts and Jobs Act, and that could pass on its own. However, there could be an expansion of that, more tax changes in tax policy and whatnot. If we have a mix in Congress, it has to get through Congress, so it's probably going to be horse trading, back and forth and back and forth. Some things will get extended, some won't. If the Democrats win the presidency, probably them sweeping the House and Senate is almost none at this point, so we're not going to go with that. But let's say split and Kamala or the Democratic nominee is the winner, the president, then it's likely that most all of that will expire. That's what's been stated publicly multiple times by Biden and his administration. I would expect that that will continue. So what this means to you, clients, is that that is probably one of the things we'll watch the most closely, because each and every one of you may want to adjust not only your estate planning as well as your personal financial planning around that. And we'll get a lot more clarity, not even after the election, probably into next year. And we'll have time before the expiration to make adjustments necessary in strategy and planning, et cetera. So I wanted to bring that up, so not to create a fear or a concern situation, just as an awareness. If you're clients of ours, it's our job to guide you and advise you if any changes need to happen around that once we have clarity. And that goes for any other policy that comes into place, depending on, again, the results of the election. So that being said, again, if you have more questions about that, let me know. And if we will have, again, Bob Stein will be speaking next month, and that's going to be where we're going to have that deeper dive with the expert that actually lives there and is deeply entrenched in the White House. Deeply entrenched in Washington, so the White House in Washington, and really knows what's happening and can give us a much clearer sense of that, because politics is by no means my expertise. But I think that covered most of the questions. I didn't delve as deeply into some of the questions that you said that were specifically on policy in relation to that, because the questions were all tied into, is Biden going to step down or not? And that's already at this point been decided. So that covered the, hopefully, the political part of it. So then we'll jump into the outlook on the economy for the mid-year. And this is one there's been a lot of questions in, because I've been speaking about this earlier in the year and into the midpoint of the year, is that we are going to head for a slowdown. And the slowdown had been postponed largely because we had an extraordinary amount of government spending. I mean, our debt levels are skyrocketing at a very rapid clip. We don't really have any precedence of this, with the exception of during the early stage of the pandemic, when it was essential to keep things running, and during wartime, where we just have this extraordinary government spending that's out there. And that does, the way that it's done is it kind of boosting the economy, right? The consumer, which is 2/3 of our economy, has kept on it, even with high inflation, rising costs, not only in goods and services, but also in the costs of, insurance and utilities and housing and everything else. Everything has been rising. The consumer collectively has really, they've done their part for our economy, gosh darn it. And part of that is kind of weird, because higher inflation and higher costs of goods also boost consumer spending, as long as people have the means to do so. That has also been assisted by higher stock prices, higher asset prices, and a very low unemployment number. So people feel more comfortable spending money, even in the pressure of rising costs. Please understand what I'm saying is very general. There's a lot of variances in that. There's some people that are being very desperately squeezed right now and are really holding on the margins. because they can't absorb these costs as quickly as they're rising. And there are also people that are not as impacted by it due to their sources of income or their overall financial situation. So when I'm speaking of things, I am speaking high level economic, not to specific situations, which vary widely, within that. So that being said, the government spending, pushing that money into the economy, and the consumer spending has really kept this economy going longer, faster. In addition, there's been a lot of investment that's taken place in the infrastructure around AI. So you'll remember us talking about AI a couple of years ago, and it was kind of a fun, cool story, and now it's real. It's coming into our lives in various ways. But companies of all different sizes and industries are investing in various levels of AI to increase productivity. And that being said, there are a few companies that are set up to benefit from this. Some companies have created this on their own. You could think of NVIDIA as a great example with having the chip that's needed as that begins to expand beyond that. But there's also companies that are figuring out how they're going to use this. Some were ahead of it, Microsoft being an example on how they integrated their AI into the Office systems, Microsoft Office systems, so it kind of got it out there more. There's also, you may or may not know, recently Apple. Apple is a company that hates to buy anybody, likes to do it all themselves. They're going to develop and build it themselves, gosh darn it, with the exception of using or contracting with Google as their primary search engine. They have really done most everything in-house, but recently announced that they're going to partner with OpenAI and start to bring that for iPhone users in various forms. So you're starting to see a lot of this technology bit by bit creep more and more into the mainstream. The companies that were positioned for it or are positioning for it are the benefiting. And the tech sector was kind of like the first round of that. And what we're watching closely now as we're in earnings season is how many other companies are integrating this into their systems. And what is that doing for their productivity? And this is we're very, very early stage now. So it's an important thing to watch. When a company finds ways to be more productive, especially when they can do it without having to lay a lot of people off or to do all these mechanisms, debt and things like that, it actually strengthens the company more than a situation where a company says, to get more competitive, we're going to lay a bunch of people off or we're going to raise a bunch of debt. Right? Issue a bunch of debt so that we have money to work with. Those are all tactics that companies use, but for long-term health, they're not necessarily as beneficial. So in this situation, when companies can use technology to become more productive, and we can start to see that in the financials, again, we're very early stage, so we can't necessarily see it in the financials yet because it's going to take time for this to manifest. But what we do see is who's making those investments and how are they making them. So in the beginning, it may not be good for the stock, right? Because the company's making this big spend, but they don't see the benefits for it for some time. So it's always can sometimes present an opportunity to buy a stock that maybe gets hit and their earnings when they're spending a lot, not seeing the benefit from it, but we can see the long-term potential benefits of that. So this is an interesting earnings season to watch that. When I talked a little bit earlier about it's a little different this time is that what we're hearing, and again, we're early in earnings, so this could change. There is somewhat of a holdback with some companies and industries on spend right now because the uncertainty around the election, and this happens every year. It's not specific to this year, which is very unusual. It usually happens because companies don't quite know where to invest until they know who's going to be in office and what the policies are going to be. So there's a lot of kind of hedging that goes on, and you can start to see that slow down in the company too. They have the money, they have the capital, but they're just not going to put it to work until they kind of see what direction the political wind's going. And you notice that, at least I've noticed in the last couple of weeks, as the election has shifted dramatically since the debate, you'll see when the markets think that it's going to be a Trump. Oh, well, we're not 100% sure it'll be a Trump. You're starting to see this fluctuations of positioning for a certain presidency, but and then, oh, wait, maybe it's going to be different. Again, that's just people trying to position what companies would prosper potentially under one administration or the other. So that, again, the economic front of it is the consumers are really driving a lot of this, but it's supported by massive government spending. But the spending on AI is not a bubble; it is real money. There is bubbles in there. There are some companies that should not be valued what they are. It's some reminders of the .com time when all you had to do is put .com in your name and you're worth $1,000 a share. There is some of that out there right now, but there's also some real money, real investment that's happening. These companies are benefiting from it. You'll likely see The markets are going to start to become more volatile as we head into the election. So I'm preparing everybody for that in advance. Two things are happening. Number one, the data is coming out, both our hard data and our soft data. Hard data is facts, numbers, and soft data is how the consumer feels, etc. All of that is starting to weaken. We're getting that across, not 100% across the board, but it's increasing the number of things that are pointing that direction. The other thing is, so that's, the kind of the data. And then also we have backwards looking information and forwards looking information. The forwards information is starting to show that too. So what I want to stress is this environment that we'll likely find ourselves in over the next, say into early next year at this point, is some of it is around the election and the uncertainty. Markets hate uncertainty. And that's certainly what we found ourselves in the political space, in the election area right now. And the addition is the fact that the data is slowing down. So people are like, okay, well, what is this going to be? A big slowdown, a little slowdown? At this point, it is highly likely it's going to be a mild slowdown, and it's probably going to last until early next year. Not a recession, high probability at this point, not a recession, just a really big slowdown, but it's going to be a bumpy, kind of like driving your car with a tire that's leaking air, right? The car's driving just fine, the engine's working, everything's fine, but you kind of feel like things are a little gunky, little kind of off. And that's sort of how things will feel. Like, well, it's not that bad, but it's not that good. And market's up and the market's down. And this news is good and this news is bad. And this is going to be the environment we're going to find ourselves in. So this is going to be an opportunity for investors to be patient, to not react to it, to not see every little drop as an opportunity, but also at the same time to see a bigger drop as a great opportunity. So there's going to be a very tactical nature in this, both at a company level, who's positioned well no matter what happens, who's investing and how are they investing towards their future. But it's also going to be an environment where it's going to be confusing for a lot of people because they either expect, hey, we're either in high growth or we're crashing into a recession. And it's going to be neither or. Post-election, and assuming the election goes as planned, and do expect if it's a close election, there is a possibility that it will be contested, much like 2000 and 2000. It may or may not be solved right away, and it may be solved right away. It may be a very clear winner, and then we just move on. But just that time before the election, expect this gunkiness to continue, and even post-election, because the post-election period between the election and then when the new administration comes in, or the current administration comes back in, especially when there's a change in administration, there's what's called the lame duck period, where the current leadership knows that they're on the out. So not a lot's happening. They're just kind of holding it together, but they know they're on the way out, kind of positioning for hopefully in the future their party comes back. And so not a lot of policy usually gets done there. So depending on how this election, depending on how it goes, could be a little bit of that as well. In fact, it would almost be both sides because we don't have an incumbent come running. So anyone who comes in is going to be new at this point. And it's going to be more uncertainty around that period of time is how does the Biden administration prepare for who's coming in next? And it will likely depend whether it's Kamala or Trump, right? So I would expect this uncertainty to carry on until the new administration gets in and they start to really clearly state what they're going to focus on and how they're going to do it, which again, as you know, could be different than what they proposed, because one thing is to get me in elected and the other one is, okay, what am I actually going to do now? Could be different. So expect this gunkiness, this bumpiness to continue into early next year. That was high level. In this environment, what I'm saying is very general. Please do not take any of this as investment advice or recommendations, as each and every one of you have a different situation and would adapt to the situation differently. So what I'm saying is, again, just high level considerations, but not in any way construed as investment advice or recommendation, and that just made all the regulators happy. So that being said, right now loading up on a lot more risk is probably not as prudent, but it's also not prudent to run away from it. So you want to be able to be on both sides. Remember, we're going to have volatility. So it's not about things that, we have to run for the hills, but at the same time, do you want to add a lot more at this time? I'd say in most cases, prudence is going to be important. Quality is going to be important. Earnings information is really going to be important, especially guidance, and just being mindful of where we are in the cycle and where opportunities may lie. This is just generally in growth assets, say like stocks and whatnot. But then we want to drive a little further, so it depends on the individual company. There's not a single time when companies aren't doing well. Believe it or not, during the worst times of the financial crisis, Apple was selling more iPhones than they ever had, right? There are companies that can navigate slowdowns, even massive slowdowns, fairly well considering the circumstances. So it is very much about the companies as well. This is the period of time before the election. Post-election, we'll have a better sense of what companies may benefit. So for an example, if their tariffs are going to be a big focus, and there'll be more tariffs placed than we have now, and they're going to be more larger tariffs, would that help domestic companies? Depends on the tariffs, right? Where do they get their raw materials? So this is going to be something we're going to be watching very closely as we get a sense of what that is. So individual companies, individual assets and whatnot. In the bond space, quality is key, but the Fed has made it very clear that they intend to cut rates later this year. Once, maybe twice. This is not going to be the be all and end all. We're not going back anywhere close to where we were back during the pandemic. They're going to keep them higher. It's prudent. Inflation is likely to come back next year, regardless of who's in office. It's likely to, because as the economy regrows, it starts kicking up again. Inflation is just in hibernation. It's not gone. And so the Fed's going to be very mindful of that. If the economy can keep itself growing with higher rates, the Fed is not incentivized to cut them more aggressively. So they're probably going to do one, maybe two, and they're going to take a break, kind of see how this plays out. Quite the opposite. If the Fed got more aggressive, the market would be incredibly concerned. That was like, wait, what does the Fed know? Oh my gosh, it's really worse than they thought. Because it's a stimulative action. Cutting rates is a stimulative action. They generally do that to stimulate the economy. So the Fed's got a very careful balance between, we want to lower rates a little bit because inflation is beginning to moderate. But the reason it's moderating is because the economy is slowing down. And so it's kind of a double-edged sword. How the market takes the rate cuts will depend. It's sort of priced in at this point. But it's really going to depend a lot on what the Fed says and the Fed minutes and what else is going on to determine that would be a boost up or not. And even day to day, it could be very volatile. The rate cuts could be somewhat stimulative, potentially, to the real estate market and to other more debt-driven assets where costs are just really, really high right now. Debt's really high. Bringing that down could give a little bit of a burst there. But again, it would not be a big change for most people. I got a lot of questions about real estate. So I'm by no means a real estate expert, but I can just share the national data numbers, which is a real estate market in itself is cooling. Interestingly, hitting higher prices on a national level, but the sales are dropping. A reason for this is twofold. Number one, there's only so many people that can afford these higher mortgage rates. Historically, mortgage rates are not that high, but in recent history, they're very high. But what's different now is housing prices have come up so high. It's not about the rate of the mortgage, it's about the monthly payment, right? And you see a lot of these markets that there's not a single house below $1 million, in some of these very expensive markets where the average person needs that kind of mortgage. Those monthly payments with high mortgage rates plus the cost of housing is very difficult for the people who need the financing to get out there. So what's kept housing prices higher for longer and prices continue to rise, even in light of higher mortgage rates and the limited number of people that can afford them, has been the lack of inventory. And lack of inventory is twofold. We have not built enough housing for the demand. The second component to it is you're locked into a low mortgage rate, you're not moving. Even if you normally would. Like, kids have left, I don't need all this house, all this yard, all these things to do, I want to downsize. Oh, wait, what are my property taxes going to be? Now, again, there are exceptions, especially in California if you're over 55, but another one is the cost of refinancing that home if you're still carrying that mortgage into a higher rate. So a lot of people are kind of, it's called the golden handcuffs, which is kind of locked in. I'm not moving. There's no way I'm going to move because it would cost me so much more to move elsewhere than just to stay put. So that has also held back inventory. But there's a natural thing. There's a huge surge in housing. Not only in transactions and price increases and whatnot during the pandemic period at a time when it was very low mortgage rates, a lot of people moving around from parts of the country. A lot of things really were a big tailwind for the real estate market. And now that's starting to slow down now. Now, it doesn't mean that we have a crash. We still don't have enough housing. We don't have the same situation where there's a lot of people that can't afford to make their payments, the mortgage payments. So it's unlikely that we're going to see a massive flood of foreclosures, though certainly there could be some. It's not uncommon due to life events. But I would see housing coming down in pricing. I would see housing prices appreciate much more slowly, but probably that's not going to be a major shift, barring some big governmental law, policy change, something happening that just makes it less attractive to own housing. So hopefully that's a high level housing. As any real estate professional will tell you, it's location, location, location. So areas that are high demand are going to hold up much better than areas that may have lower demand. High demand areas, we have 10,000 people a day turning 65. There are certain areas that people prefer to live if they can move to them, that are more attractive for them. Maybe it's climate, maybe it's where their families are, maybe it's other amenities that they want. Those markets may hold up better than some of the areas where, you know, there's a lot more room to build and grow. And again, perhaps as there's less demand, people are more selective where they live. So certainly if you are, as this question asker was, if you yourself are considering buying or selling real estate, I can't stress enough, 3 people you always want to know and talk to. Your financial planners, yay, Sequoia, because we can show you the best ways to finance it, all the options, pros and cons, tax considerations. Like we can run through the whole gauntlet of the planning aspect of it, which is very helpful. Also, we are not compensated on the transactions, so we don't have any incentive to get you to go one direction or the other. So pros and cons, best ways to finance it. There's a lot of ways to finance housing that people are not necessarily aware of that don't involve getting a traditional mortgage. So sometimes there's other things you may want to consider for housing purposes or purchases, sorry, on that. So definitely, again, your financial planning team, your CPA. After you've done the plan, you bounce up your CPA, get the final tax blessing or tax understanding, especially if you're a seller. And the final one certainly is your realtor. And I should throw in the mortgage broker and professional as well if you're going to finance it. These are a really great team to have around you because they're going to be able to give you, within their expertise, all the pros and cons, and it helps prevent situations where people make a decision based on only a piece of the puzzle and not the whole piece of the puzzle. So again, a little bit off the economics of it, just because this question was a little more detailed about some decisions to make, and this situation was a first-time purchase, so this is all new. So have your team around you and look at the options. And that even though ultimately for most people buying a house does come a bit down to emotion, you love it or you don't love it, you really want to live there. It's nice to have all the financials there, so you're sure that you're making a decision that you're going to be comfortable with long term. So that being said, that was the biggest part of the kind of the stock bond section of it as well. I did want to take a moment or two, and I'm just going to this one over here to talk about some other areas that people have already been asking about as well. So you have the bigger economy as a whole. So we talked about the stock market. We also want to talk a little bit about some other things. Remember, there are other things to invest in. It is not just the world of stocks and bonds and CDs and cash and real estate. There are other things. And these types of environments oftentimes provide opportunities for things that you may not think of. We call them non-traditional investments. Each one of them carries its own considerations, potential risks, potential benefits. So it's really important to understand how that would potentially fit in your investment portfolio. Many of my clients have some of this in the portfolio, and it can be a great balancer to some of the volatility and the other aspects of it. So balancing that out in light of, again, of your specific risk tolerance and goals is a really good thing. There's a lot more out there in the world, and there's a lot more different ways now to become more and more accessible to more investors than it was in the past. So don't limit yourself to just the stocks and bonds world. There are other things, and where appropriate, that is in the client portfolios. Economically in the United States, I talked about a little bit, unemployment levels will start to rise a bit. We're likely to see very high numbers, anything like we would see, say, in a recession. The reason for this is lack of workforce. We just don't have enough workers for the currently available jobs. But the jobs market is going to change, and we're going to see slightly higher unemployment numbers. That's very likely. Of course, this will be a lot of noise in the media and in the news, especially as, you know, we're going through this election period. This is just a natural flow if we just had extraordinary low numbers for a long period of time, because we have all this government spending and all this booming economy, and all these people are, you know, they need to hire people, and whatever it costs, they're going to hire people because the work is there, the business is there. But that's going to slow down a bit. Again, not highly unlikely it's going to be anything close to of significant numbers, but it is going to go up, and you're going to hear a lot about that. Certainly, that is a time, if you are working, is a consideration to be aware of, that can change. Some sectors and industries more so, and some less. But that's something just to be aware of, that in this bumpy period of time, you're going to start to see some of those increases, and probably into early next year. The overall, push towards it from the United States perspective is growing, but much more slowly, with a lot more volatility. Is going to be the course probably for the rest of this year. What could change that and make it go more one direction or the other? It's really hard to get anything through Congress or any major government spending, changing policies, additions during an election year. It's just really difficult. And especially this election year, because of just what's happening with President Biden and everything else. I don't really think that we're going to see anything big. So there's probably not going to be anything else pushed through or gotten through or done. And that's, again, in a normal election year, it's the case, but this year especially, I don't see very much more big. There'll be some, what I call talking points. Oh, we're going to do this or that or this because of from the election standpoint, but actually getting things through is unlikely. So I don't see the government spending to go up much more than what's already approved. But trust me, it's enough. We already still have a lot of money that's flowing in that's already been approved. From the other component to that is, so slow down is we also have, of course, the geopolitical environment. So we have a lot of instability going on in the world right now. Kind of the biggest ones are, of course, the Ukraine-Russia situation has not gotten any better. Recent months, Russia continues to take territory, and there's an uncertainty of the outcome of this conflict, and there's an increasing talk of trying to find some form of negotiated settlement. This is coming out of more and more voices. What this looks like, I don't know. From an economic standpoint, it doesn't really have a big economic impact, except for one area is just all of the money that's being spent towards the war effort, especially within Europe, that can't easily print their own money as we can. That money could potentially be used, maybe even if it's towards European security or used within Europe. And that may help stimulate the economy there when there's not this immediate need to give money to the Ukraine to fight this conflict. So there's a little bit of a potential, but it's kind of down the road. We just don't know what this is going to look like. The outcome of that may well be very much hinged on the outcome of the US election, just because different administrations may well have different ideas of what US support would look like going forward in that conflict. The other one is a situation happening in the Middle East. That is the biggest wild card of all, because at any moment that can easily spiral out of control, and we start to pull Iran directly into it, we start to pull other Middle Eastern countries into it, and then this conflict becomes a big deal fast. And we don't know what is going to happen there, so I'm not even begin to try to predict it, but that would actually almost certainly have an economic impact. The biggest one is going to be the cost of oil and energy as that area gets disrupted. So that is definitely a watch point. And there's so many moving parts to that, and there's so many actors that are out of any state control involved here, that it's going to be very difficult to know what will happen. But it really just takes one targeted attack in a certain way that this whole thing kind of blows up. So that's probably the most imminent risk than geopolitical, has an economic component. Final one is China. Chinese economy is really struggling right now. And when China has a really unique situation that they have to grow about 6% a year just to really prevent social unrest. It's sort of a dangerous situation over there. The government has got to continuously find ways to grow, like the shark that can't sleep, right? It has to keep moving. It has to keep growing to prevent that unrest. Such a large population, a lot going on there. So if things continue to deteriorate there, China may become potentially more inclined to get a little more active, say, in the situation with Taiwan. And maybe that potentially becomes something more to say. That would actually have the biggest economic impact upon all of us if that happens. From a twofold standpoint, number one, any conflicts there, any disruptions to Taiwan and the trade with Taiwan with the rest of the world will have a big impact on a lot of areas right now that are critical to our economy. So there's no way that any conflict, or even a quiet conflict over there, if that starts to get worse, it's definitely gonna create economic issues for us, pretty significant ones. The tariff situation I talked about earlier, it's one of those things where it's sort of a double-edged sword. And we kind of saw this early in the Biden administration. He was like, no tariffs are bad, tariffs are evil, that's a Trump thing, we're not doing it. But then later in his term, he started with tariffs, especially like the 100% tariffs on Chinese electric vehicles. to protect the U.S. domestic automakers. So there's times when you can say, hey, we don't want to do it because we don't want costs to go up and we don't want the public outcry from that. But at the same time, we need to protect our domestic. So if Kamala comes in and she continues to run Biden's policies, like she just goes along with what he was doing, she may well also continue on with that fashion from a standpoint of the big focus was onshoring, right? Bringing more back to the United States, which was the fascinating thing to see. One of the few times you can see the Democrats and Republicans on the same side, which is bring it onshore, do it here. But if that continues, then you could well see more tariffs coming out of even the Democrat administration, not just necessarily Trump. So that's something to watch for. That will have economic components to it. One is just tariffs here and there, a little tit for tat. Another one is a full-on trade war. So that's something we're watching for, and that may well depend again on China's behavior and whatnot. So, boy, trying to cover like all of this different things in this economic report for mid-year. So I'm going to jump into the questions if it's okay. So again, any questions that you have, just send them on over. If not, then I'm going to go. I mean, I love your questions because that's the test. When you send them in advance, you can say, hey, I researched it. But when you send them in right now, it's better be here. You'll catch me if I don't know what I'm talking about. So go for it. Okay, should I be updating my estate plan for the tax cut expiration? I think we somewhat talked about that a little bit, but I'm going to bring that kind of a little bit more to the forefront here because you have a window potentially, and I'm going to tell you why potentially. You have a window from the election to the incoming administration to get a sense of maybe what they're talking about, and the expiration, which is the end of 2025. So what to do about that will so depend on what happens to the election and where the focus is going to be. My only concern and why I'm careful on this, I don't know how overwhelmed the attorneys are going to get if there's going to be major changes and everyone's trying to get things updated at the same time. So with that being said, it's really something you really want to talk to us or your financial planners, your estate attorney and whatnot, and kind of bounce those ideas off of them because it's really hard to say. So the caveat, in addition to the attorneys, could be up to their eyeballs. So maybe establish a relationship with the attorney now. You don't do anything just to get in line. The other one is that there is always a little risk of one thing, which is, yes, it's going to expire. And this one's a little easier because there's an expiration date on it. But what if we have an incoming administration that comes in, and it's certainly, again, it'll be the Democratic side because it's Trump's bill. He's going to want to keep it going. They come in and they say, we're here to protect the American people. We're going to rescind this all from day one. And they push it through Congress, and now it's gone faster. I'm not a political expert on the technicalities about this. It depends on what it's focused on. But we had this during the Obama administration, where, and not only in the Obama administration, but also at a state level in California, where a law would be passed, but then it would go retroactive to the end of the year. So there'd be no chance to do anything. Like, we don't know. Okay, great, I'm stuck. Instead, there was like a little window to do some planning. Sometimes they'll say, law's passed and it's effective next year, which is only 2 months away from the election, right? So there's no time to really do a lot of things for people. That was the case with Prop 19 in California. There was just no time to get things done because it was this tiny window once that law passed. So that's maybe a long-winded way of answering this question, is that I would consult with your planners, consult with your attorneys, make sure they understand the specific situation looking to do. And even if no change is warranted now, just establishing that relationship will put you ahead, because what often happens is people react after the fact or closer to the fact, right? It's like, oh my gosh, it's coming up. I got to do something. So you want to be ahead of that. Probably should make it changes here. So the other question, okay. So the question is, if Trump gets reelected and the Democrats control Congress, what would that look like economically? Okay, well, you did catch me. I don't actually know. I don't know because I don't know exactly what would be focused on. So, it's going to come from the president. It's going to come from Congress. And I want to save a lot of this, like for the post-election recap. Maybe we should do that. The first webinar after the election, we'll talk about these things, because it also depends. Don't forget, it's not just party. It's also how far they are on one side or the other. So you have moderate Democrats, right, that are pretty fiscally moderate, pretty socially moderate, but they're Democrats. And you have Republicans that are moderates. And they can kind of work together and get things solved. And, they tend to have moderate things which work more for more people. I'm just being very general here. But then you have people on the farther sides, okay, the farther right, the far left, that can have policies that are a lot more onerous or a lot more limited in scope, a lot more further out, can have more policy implications, especially if it's a big shift from how things are now. So it's not so much just the Democrats or Republicans, it's also who is there and what are their philosophies? Are they very progressive? Are they more moderate? Are they very conservative? Are they more moderate? And we'll have to see that. So I feel like I really can't answer that question yet with that. Okay, same person, second question. Oh, that's not fair. I know who you are too. It says, who's better for the economy, Trump or Kamala Harris? I'm going to pass on that question. No, and I'm not doing it because I don't want to take a side. I can't because I don't have enough information. I can't have enough information. Generally, moderates do better than the extremes, but the extreme is a very subjective term. Right now, sometimes anyone to the right or left of me is extreme, right? We're kind of in that environment right now. So generally moderate, and the reason for moderates is they're more likely to negotiate and try to find a way forward. And I can go back to welfare reform under President Clinton. So President Clinton, when he got in office, he was a moderate Democrat. He's a moderate Democrat, right? And he was willing to work with the Republicans on welfare reform. And his party was so mad at him for doing that. They were so mad. You're a traitor, a bad person, Clinton. You're supposed to be one of us, and you're working with them. But he did it. He found a way to work together. He didn't get everything he wanted. The Republicans did what they wanted, but they got it done. So that environment is different than the extremes, which is, I'm not talking to you, I'm not talking to you, I'm not working with you. We're all enemies here, which has been more common in recent years. So that, again, comes down to, it's not so much the party, it's more the policy and their willingness to work together. And again, that's a little bit of a personal opinion there, not economic opinion. It's just generally when people work together, you're less likely to have extreme by just the general sense, and you're more likely to have some form of consensus or negotiating, working together. So we'll see. But I don't even know that I can ever answer that question, because there's also, don't forget, economy is very personal. Which is what is good for one may be bad for another, right? Economically. And sometimes also people can get very caught up in the news and think something is one way when it actually a very different way. But the news media is grabbing it, and depends what media you listen to, what your own personal social and political beliefs are. So there's a lot of variances in there. Maybe I'll just go a little bit on that segue on that one to say, a couple people said, how do you decide who to vote in this election? This was before, of course, all the change. Maybe they can just say that there wasn't a lot of enthusiasm for either candidate. I said, well, I don't belong to either party. What I usually do is close to the election, I just go to their websites. Each candidate I'm voting for, down the ticket, right? I go to their website and I read what their policies are from their own self. I don't have to worry about fake news. I don't have to worry about opinions. So what do they say they want to do? I understand they can't do it all. I understand that they have to get things through Congress, and they may change their mind when they're in office, and I understand that. But at least it gives me a closest idea to what their thought process is. And maybe in a sense, that's a good place to get more clarity on that, the economic components to it, of what, or whatever, not just economics, I should say, whatever is important to you, is you go to each one, even the one you don't like, go to each one and read what they have to say. Because can't tell you how many times that I've seen the news and they say so-and-so did this and such or said this and such, and it wasn't true. So just hear it from the horse's mouth, not from the media, would maybe be helpful. And then make the decision that feels right based on your beliefs. Okay, if I move closer to my son from California to Idaho, will it change my Social Security? No, it shouldn't change your Social Security on a high level. There's a little wrinkles to that too, because the Social Security tax, would that look different? Other factors in your financial life. So please do consult with a financial planner to get clarity on this. Also, you can consult with the Social Security office directly. They'll be able to give you some guidance there as well. Your biggest consideration, because I don't know who this is, your biggest consideration here is going to be your total cost of living, not just the Social Security. So there could be parts of things. I mean, California is a very expensive place to live, but if you've lived in your house a very long time and have very low property taxes and very low costs to care for that home, maybe it's not as onerous. But California overall is an expensive state. Idaho, I'm not as familiar with, but I would imagine it's a much cheaper state to live in many ways. But even that can depend, I'm sure, on where you live. But there's a total factor. Anytime you're moving to a new state or even a new location from this state, is you want to look at all the costs, not just the costs of the home or the cost of or tax savings or anything like that. It's a total cost. And I can give a really good example of if you're in a state with more variable weather, you may pay more in utility bills to heat and cool your home than you would say in the coast in California. So there's just a lot that goes to it. Final thing is your quality of life, where you spend your time and your money. Just use an example. Let's say you love to go to the big city and go to the plays and you like the big city life. And now you live in Santa Cruz and you just drive up to San Francisco periodically to do that. And you drive back. Okay, your costs are lower than if you're far from that big city and you're going to need to fly there and spend time there or drive there and spend nights there to have that lifestyle. So all these considerations come in. I would strongly suggest do some financial planning, basic financial planning with us or another financial planner, and kind of see what your personal costs are going to be all in, if that's an important part of the decision. You didn't mention if there's like grandkids involved or anything. There's more to life than just the money, but you also want to make sure that you don't find yourself pressured to the point that you can't enjoy your life. So that's a good planning question. Are we in a tech bubble? It depends how you define it. Nothing like .com. The money being spent for AI and AI infrastructure, for the most part, is money being spent that will have a long-term impact. AI is more like the internet in the second round after the crash than it was in the first round. There are companies out there, there are investments out there that are just putting AI on their name, but they don't have any revenue to show for it or anything they're doing different than anyone else. So there's a lot of risk out there. Be careful with, you're investing in AI and knowing what the heck that means. So there are certainly bubbles in it, but collectively it's not a bubble. But I would expect, it is very highly probable we're going to get a pullback, and these companies have done very well. And it doesn't mean it's the end of the world, but it does mean that entry points here should be done cautiously and with some level of knowledge and skill. But yeah, not the bubble like you think of .com in the 90s. Not yet your client. My sister is. I want my husband to retire so we can travel. He wants to work. Life is short. Help. That one's a planning one on many, many levels. And this one, and again, I'm trying not to come across as plugging for Sequoia here. There are other certified financial planners that work on a fee basis, not selling anything. This would be a good planning scenario. And I'll tell you why. It is not uncommon when one person wants to retire before the other person. Sometimes it's because they love their job and it gives them a sense of purpose and they're so into it. And the other person's like, I'm done. I work for the money. Kids are launched. I want to travel. I want to go see family. I want to do stuff. So not necessarily be on the same page with a couple on the retirement date is really, really common. It's actually more uncommon. Everybody's on the same page. There are a lot of ways that one can retire before another one. And the one that retires first does things that the other one would be less interested in. I did quite a few plans with that where we kind of create those bucket lists and like, here's the stuff I love to do. He or she doesn't like to do. Great. Go do them the next 2 years, right? Let's financially plan how you're going to do that. You do all this stuff. So by the time the other person retires, then you're doing the collective things. And there's other ways to consider it, but you do want to do on the financials. You want to run the numbers because what you want, the ideal situation is you can fully enjoy your life without feeling pressure or concern that you're spending too much. You won't have enough. What happens if you need, long-term care in the future? How much can you help your kids? Like all of these questions can be answered financially. Like you'll understand the financial aspects of it. And then, of course, you'll still make the decision right for you because it's not all about the money. The money's just the tool. But it takes away that fear and that pressure. Am I doing the right thing? It's their consideration. So I really would suggest the planning aspect of it. And in the meantime, if he does work longer, if he chooses to, then what can you do in the meantime? And how does that balance out financially? Not knowing you and not knowing your specific situation, it's hard to go too much beyond that, but I'll be happy to talk to you if you'd like, especially if your sister already knows me. Myself or Katie on our team can kind of answer a lot of these questions for you. And the other one, the final thing is always the why to working. Sometimes people work because they don't actually know what they're going to do when they don't work. So often our identities can be tied around our work. Then all of a sudden, when you stop, people think, oh, it's great, you're retired. How wonderful is that? You're free. You don't have to wake up in the morning and go to work. And But that's purposeful. That gives someone something to do every day. There's a purpose behind it. It's not just a financial decision. So if there's a really important, before you take that step of not working for money anymore, that you make sure that you've got an idea of what you want to do. It doesn't have to be specific. You don't have a calendar with every day scheduled, but an idea of what things you'd like to do, what we do at the time we will accomplish. So you don't find that point where like, I'm bored, I'm miserable, now I'm getting depressed, now this and that. And it's because it's what happens when there's not one purpose is replaced with another purpose. And even it doesn't have to be well defined, it's just an idea. Oh, I just want to try this and try this and try this and try this. There's still something happening. I think that's an important consideration to have in your planning. Let's see, another question here. You talked a bit about China. Do you think that we will have an active war with China to defend Taiwan, or if it's going to be more of an economic issue? Wow, see, that's all of these questions. I don't actually know the answer to that either. That would be something that our Washington experts would have a better time of explaining than I would be able to know. I focus much more on the economic components, but from a military situation, I don't know. My highest advice on that one is don't fear it, don't worry about it. It's completely and utterly outside your control. Live your life, enjoy your life, plan your life. But about these things that you have no control over, it's just an exercise in making yourself unnecessarily unhappy. So I said this kind of one of those out of control situations. Economically, we both are kind of symbiotically connected to each other as a symbiotic relationship. If we harm one, the other's harmed. And it's still very much as yes, China has pulled more and more away from their dependency on our debt, or purchasing of our debt. On the other hand, we've pulled away more and more with our dependency on having factories in China. So we're slowly decoupling ourselves, but we're still very, very connected. So that would minimize the risk of someone doing something just crazy, right? Because it would harm both. But you don't know. You don't know what people are thinking there. You don't know what people may think here. And you don't even know things outside of our control completely. So that being said, oh, another one. Okay. Oh, you guys are just fun today. Okay. Oh, no, actually, no, this is cool. Sorry, that was going to be more political. So as many of you guys, they're referencing this. So as many of you know, but maybe not all of you listening, every Monday, we're on a call with Washington, D.C. It's a Washington economist. And this is specifically for us economists that are basically enrolled in this group. And it's, you know, to be accepted in this group is a pretty big deal. It's kind of special. That's kind of the group those of you who see me with Greenspan and other people, that's the group that I belong to. So and the rules of that is you have to be an economist of a certain standing and you can't be political. Like it has to be nonpartisan, 100% nonpartisan, because we're kind of tasked with understanding what's happening economically, but also trying to sometimes solve things economically. And oftentimes in our Monday call, we'll even have senators or congresspeople from different parties listening into what all these economists have to say. So it's kind of really, really fun. And I try to do it every Monday. So each Monday, and the thing is they're talking about what's happening in Washington that has an economic component, and it is nonpartisan and non-political. So it's a refreshing breath of air to see Washington from that standpoint. So the question was, what did your Monday call say about what happened to Biden over the weekend? And my answer is that they didn't really talk about it very much, but that was the question most of the economists had. And the only thing they stated because the question was what brought him to this decision to step down, and the answer that we got was it wasn't really his choice. That he was given an option, or it wasn't really what he wanted to do. But it sounds to me like what they said is that he was kind of like, you're going to do this or this is going to happen sort of situation. They did not elaborate. A lot of people were theorizing, but there was not a specific set. So I'm sorry, I don't have any more information than I'm sure whatever is out there in the world right now. And ultimately, like I said, this sort of one of those things we can't control. So we're just going to go with what we're being presented with. So that being said, I know we're getting to the end of the time. My highest intention, as always, with this hour that you're spending listening to me is that you get value out of it. It's a balance to try to cover such a wide variety of information that's out there, and bring it home and bring it relevant to you and to your questions and to your lives. Please know, anytime you have questions about anything I talked about today or anything financial, whether it's personal or a broader level, don't hesitate to reach out to me. I spend an extraordinary amount of money on my research and my data, and it's really good stuff. I'm happy to share it with anyone who's interested. So don't hesitate to say this is more of a broad kind of where we are situation. And you may have specific questions.